Hello friends, last week in my video we saw how the traders were preoccupied with the expiry and rollover process, and at higher levels we witnessed some amount of profit taking. Now there have been some geopolitical developments and to be more precise, there's been a ceasefire announced between Israel and Hezbollah, and there also have been feelers by Zelensky that he might be willing to negotiate an end to the war in Ukraine between Russia and Ukraine. Will this cheer markets? Will a December Santa Claus rally be seen in the week ahead? We are going to break December into 4 equal weeks, and we are going to see whether each week is likely to see a traditional empirical rally that we are used to seeing in December. Why do Santa Claus rallies occur in December? Because hey, it's the financial year end of the FIIs, and performance bonuses of fund managers depend on the net asset values, which are then boosted up. So will that occur, or is this December going to be any different? We are going to take that as a talking point in 4 videos in December. Right now, let's start with our usual format of the video. And coming up on your screen is the weekly market roundup window. And what you can see is that the rally was powered by the Bank Nifty, which gained more than the Nifty 50 yet again. We saw the US dollar index, the Dixie, fall sharply, and that caused a relief rally in emerging markets, including India. Now, a fall in the Dixie should have been bullish for a bullion, but there was some amount of profit taking there, where gold fell 0.75%, whereas silver saw a marginal market uptick. Crude oil fell because the ceasefire brought in some kind of profit taking by relieved market. Natural gas went up due to seasonal winter demand. Do remember, this is a fuel of choice for indoor heating in the winter months in the Western countries. The Indian rupee fell against the US dollar, which the Dixie was weakening against the global market of currencies, but the Indian rupee continued to fall against the dollar because of A, we saw the GDP growth come down to a 7-quarter low, and B, we saw declines in our forex reserves. So that was basically telling on our currency peg. The Indian 10-year sovereign benchmark bond yield saw a decline of almost 10 basis points, which means the bond prices were up, which was one of the many reasons why the Bank Nifty outperformed the Nifty 50. NSE gained market capitalization of over 3%, which was a good thing, and that tells you that the buying was fairly broad-based. Market-wide position limits, or MWPL, fell routinely on expiry, and the US headline indices went up and thereby provided tailwinds to domestic market sentiments. Friends, I now come to the ratio chart, and for a change, the Bank Nifty divided by the Nifty 50 shows an upthrust. Though at higher levels, I would admit that profit taking was seen, but the size of the real body of the bullish candle was bigger than the last 3 candles. So we are heading towards the 2.30 odd levels, which is a bare minimum I would want for this ratio to go before I would say that the upthrust is sustainable. Now, why is this ratio so important? For a simple reason here. The weightage of banking and financial sector stocks is 34.25%, and whichever way this segment of the market goes, it takes the broader market with itself. Now, friends, I come to the in-house exclusive indicators. I start with the market-wide position limits. There's a special video on MWPL here. Please do watch this video. It's an eye-opener for you. And what we are seeing on the weekly chart on your screen right now is a huge decline in the MWPL. But this tells you only part of the picture. The part of the picture is because 45 new stocks have been added as of Friday in the Indian F&O stock list on the NSE, which is why the MWPL appears to be far lower. But what happens if you were to discount the Friday levels, what happened on Thursday, the day prior, when these 45 stocks did not get included? Hey, still it was 26 odd percent on expiry day, which is still a multi-quarter low. That tells me that buy and hold or two marshmallow theory traders were showing signs of caution. They were not really buying too much. I have explained to you in my past videos how there has been huge amount of volatility every month from June. So you had election day result announcement day decline, you had a budget day decline, you had August, September and October declines, and the kind of volatility that an average retail Joe has suffered and paid mark to market for has unnerved him. So we need to watch the MWPL very, very carefully in the week ahead. And I update these daily data figures on my social media accounts every single day. Do take the effort of connecting with me. My contact coordinates are in the fag end of this video, as well as in the description below this video and a pinned comment below. Now friends, I come to the stock and index futures turnover data. This is 3 derivative series, so it's December, Jan, Feb. Now what you are seeing is that stock futures turnover has shot through the roof. Remember, this is the weekly chart. So we are at period high almost there. The reason being, it's expiry. Traders close their position in the expiring month and reinitiate the same trades in the next month, which is why the turnover goes up very sharply. Every 4 weeks, you're seeing a big spike there. Now, will this turnover sustain? I don't think so. So the coming weeks will be very critical to watch. Now, friends, I come to the advanced decline ratio, which has gone up very sharply from 1.20 in the prior week to 1.71 last week. This is an average of all 5 trading sessions last week. That tells me for every 100 losers, there were 171 gainers. Is this ratio sustainable? Sort of difficult to sustain, but as long as the ratio remains above 1.0, I would say that the bulls have an upper hand in the market. So, ideally speaking, if at all there is to be a Santa Claus rally, if at all there is to be a relief rally due to the ceasefire and a possibility of peace in Russia and Ukraine, the advanced decline ratio must constantly remain above 1 with rising indexes. Now friends, I come to the Nifty and Bank Nifty prompt month futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot, exactly like options premium. You see the basis kind of erode as expiry comes closer. But all other things remaining constant, a higher basis shows higher risk appetite and a lower basis shows lower risk appetite. Now we are seeing the Nifty basis at a multi-week high, whereas the Bank Nifty basis is the highest in a little over 2 months. Is this basis sustainable? Well, frankly, coupled with the other data of churn ratios and TSTs, etc., I don't think these elevated levels of basis are likely to sustain in the week ahead. Here again, this basis data is updated every day on my social media accounts. Let's watch out if the basis is to sustain, which I say is difficult. I would say that the bulls are coming out aggressively. Now, friends, I come to our in-house indicator, the impetus. The impetus is a momentum indicator. It tells us whether the rally or decline that prevailed in the period in question was forceful or not. Last week, both the indices have gone up and the momentum or the impetus has been up sharply, more so in the Bank Nifty. So it tells me that buying was forceful. As long as the impetus is rising along with the price, I would say we are okay. Here again, this data is updated every day on my social media channels. Friends, I now come to our in-house indicator, the lift, weight, thrust, drag indicator. And you've trusted this for 3 years now, and it stood the test of time. Although the LWTD reading is still in the negative at minus 0.04, I would say that short covering would be seen on declines in the market. Had the LWTD indicator risen to above 0, I would say fresh buying would have also come in. But as long as the LWTD is rising, I think bulls might just attempt to find their feet, but it's going to be short covering. We need fresh buying ideally to propel the Nifty to a new high, although a new high in the coming week seems a stretched out long shot. But I would say as of now, I would not short the Nifty 50 very, very aggressively unless the daily LWTD, which I happen to update on my social media accounts, shows a decline again. That we will continue to monitor, of course. Friends, our in-house indicators done. I now come to the bond markets, which I have been tracking ahead of equities for many years and far ahead of the contemporaries who watch the markets here. Now, what we have seen is the Indian bond yields have fallen almost 10 basis points. That means bond prices have gone up. Why? Now, you see, on the 4th, the RBI Monetary Policy Committee, or the MPC, is likely to announce its decision on what they are thinking about the interest rates in India. Are they going to cut? If not, they are going to cut. Are they going to cut in the future? When will they cut? What data will they watch out for? Each and every nuance will be monitored very, very keenly by the serious guys out there. So please do spend that 45 or 50 minutes that the Honorable RBI Governor delivers his speech on public platforms, and I assure you the time will be well spent. As of now, I'm holding on to dry powder. I'm not investing in either gilt funds or in Indian 10-year benchmark bonds because we've already lagged since 2021. I have recorded a special video on the outlook on the cost of funds and also a France update on France about how they are experiencing extreme difficulty in mopping up funds as the cost of funds is going up. Do read all those data points and watch that video, please. Friends, I now come to the Bank Nifty, which led the rally from the front. Now, why is the Bank Nifty important? Because of the weightage. 34.25% weightage of banking and financial sector stocks makes this a swing sector. Now, as the daily chart on your screen tells you that this index rose 1.80% while rising on 3 out of 5 trading sessions last week. It opened with a gap up and the gap was never tested, which tells you that the optimism prevalent in the market sustained till the end. The price is above its month-long moving average, which itself is sloping upwards, so the short-term outlook is positive for now. The weightage of this sector is extremely critical, and therefore the broader markets will look at the Bank Nifty a lot more keenly in the week ahead. The weekly chart of this index shows that the price has broken out with a gap, but higher levels could not be sustained, which is why there has been open and close of the week almost at identical levels, which is also happening to be in the lower end of the week's range. Now that is a mild concern. The price is above its 25-week exponential moving average, which is a proxy for 6-month long holding on cost of an average investor, which means the medium-term outlook is positive as of now. And the bullish wedge lower trend line is offering good support on dips, and therefore I would watch the 50,000 round number as a good immediate support to watch out for. On the flip side, 52,500 level is a resistance which must be overcome if bullishness is to return on to this index. Friends, in the week before last, this index was number 3 on the most volatile counters list on internal beta rankings that I maintain in-house. It rose 1 notch to number 2. Challenge levels just went up for the retail guy. Last week, I advocated an estimated range between 52,725 on the upside and 49,525 on the downside. Admittedly, my resistance area was overcome by 35 points because the Bank Nifty made a high of 52,760 as against 52,725. But then 35 points, I think, is something we can live with. In the coming week, I estimate a range between 53,650 on the upside and 50,450 on the downside. In addition to this data range, please do watch the daily, weekly, and monthly pivots that I share on our free Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.94% in the week gone by. It rose on 3 out of 5 trading sessions last week, but couldn't sustain above the month-long moving average, as you can see on the daily chart on your screen, and the moving average itself is pointed downwards. The head and shoulder neckline has acted as a rough and ready support at 23,900 approximately, which must be defended in case of declines by bulls here. The level of 24,350, which I mentioned last week in my Live Mint column, which is India's first and only media column which offers statistical data to its readers and it's free to read. It remained elusive. I'm talking of the 24,350 hurdle, and this is a hurdle that I would watch out for in the absolute near term. Although an absolute reversal in sentiments towards the positive side would be possible only above the 25,250 level, which is a long shot in this week ahead. Now let's turn to the weekly chart on the screen, which shows the price attempted to rally past the 25-week exponential moving average, which doubles up as a 6-month long holding on cost and average of an average retail trader, but the close above the average failed to materialize. Bulls seem to be indecisive last week. A big push is needed to trigger short covering come fresh buying in this week ahead. The rally must be accompanied by banking and financial sector stocks, or it will falter on advances. Friends, in the week before last, this index was number 8 on the most volatile counters list that we maintain in-house. It remained constant at number 8 itself. Last week, I advocated an estimated range between 24,550 on the upside and 23,275 on the downside, which held perfectly well. In the coming week, I estimate a range between 24,750 on the upside and 23,500 on the downside. In addition to this range, please also watch the daily, weekly, and monthly pivots I share on our social media accounts. Friends, I now come to the last bit of statistical analysis where we gauge the retail risk appetite in the 4 segments of the derivatives space. Index futures turnover contribution went up by 3 basis points. Stock futures turnover contribution went up by 47 basis points. Like I mentioned before, it could be also because of expiry when traders are closing their trades in the expiring month and reinitiating them in the next month. So dual turnover is reported. In the relatively lower risk options segment, index options, which happen to be the lowest risk instrument of all, saw a decline in turnover contribution by 54 basis points, and stock options turnover went up by 4 basis points. So net, I would say that risk appetite was higher. That is still optimistic. Now friends, I'll explain my week-long trading strategy very briefly because it's unchanged. PSUs will remain on the top of my mind recall and in my heads up display. Banking and financial will also be on top of mind because of the RBI Monetary Policy Committee meeting and the possibility of guidance on future rate cuts. The long-term bullish story on bullion remains intact. As a matter of fact, I've recorded a fresh video like you wanted on bullion targets in 2025 and 26. Please do make it a point to watch this video. Industrial metals may run into resistance on upsides, which means that stocks of metal mining companies might also witness similar resistance at higher levels. Theta decay on energy commodities continues to be my favored strategy for the week ahead. As a matter of fact, possibly even in the month of December. Theta decay will also be my chosen strategy on interest rate sensitives as well as metals. I have explained to you on my Telegram and WhatsApp channel as to what I expect in the case of cost of funds and in the case of what is likely in the months ahead. Friends, if I have any more ideas to share with you, I would gladly do that on my social media platforms. Do take it as an opportunity to connect with me, and let's stay ahead of the crowds by interacting together. Friends, before I sign out of this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know what my videos do and help you become a better trader, and what I can record in the future so as to continue to help you in the future ahead. Also, please share my videos with like-minded smart traders like yourselves and help me reach out to a wider audience. I thank you for your patience in being with me in this video. Till we meet again next, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.